Welcome to the Byte-Size Brief. Today we are putting SoundHound AI, S-O-U-N, that's S-O-U-N, completely under the microscope.
Okay.
Let's get into it. If you look at the market right now, there is just this incredibly intense tug-of-war happening.
Oh, absolutely. It's wild out there.
Right, and if you are an investor, you are basically caught right in the middle of it. Like over the last 3 months, the stock has dropped 43%. A lot of that was dragged down by, what volatility across the entire AI sector.
Yeah, the whole sector took a hit.
Exactly. But then you actually look under the hood at the business itself, and it's a total paradox. I mean, the company is posting absolute record revenues. They're absorbing these massive competitors, and yet they are sitting on roughly 38% short interest. Like, that's huge.
It really is. It's one of the most fascinating dynamics in the market today because you have the fundamental business metrics telling this story of explosive, undeniable growth, and then
the market mechanics are basically screaming severe skepticism.
Precisely. Severe, almost aggressive skepticism.
And that is exactly our mission for this deep dive. We're going to lay out the entire roadmap for you. We're going to unpack their underlying technology, dive into their highly aggressive new acquisition strategy, examine the cold, hard financials from their latest quarter, and, well, finally break down the actual mechanics of this short squeeze setup right ahead of their May 7th earnings report.
Which, frankly, is shaping up to be one of the most critical catalysts in the company's public history. It is a true inflection point.
Yeah, for sure. So before we get into the wild stock price movements and the squeeze potential, we have to understand what SoundHound AI, S-O-U-N, is actually selling. Like, why are they beating out massive tech giants for these enterprise contracts?
It's all about the tech moat.
Right. It all comes down to their proprietary foundation model, which they call Polaris. And the data here is just striking. On standard industry benchmarks, Polaris shows up to a 35% lower word error rate than the models built by the biggest tech companies in the world.
And we really have to stop right there and explain why that benchmark matters, but also, well, why it's not the whole story.
Okay, what do you mean?
Well, standard benchmarks are often tested in highly sterile, perfect audio environments. But here is where the thesis for SoundHound AI, S-O-U-N, gets much stronger. When enterprise customers actually test Polaris on their own specific noisy real-world data, they are seeing a massive 70% improvement in accuracy.
Wait, 70% compared to big tech alternatives?
Yeah, exactly.
That is a massive jump. Why does it perform so much better in the real world compared to the lab?
Because of how it processes acoustic complexity.
Yeah.
Let's ground this in a real-world application. Think about the Indian market. SoundHound AI, S-O-U-N, recently signed major deals to bring their AI into millions of smart devices there.
Right.
Including huge partnerships with two-wheeler original equipment manufacturers, so automakers who build scooters and motorcycles.
Oh, wow. Okay, so voice AI on a motorcycle, that sounds like an acoustic nightmare just from the wind and traffic noise alone.
It is an acoustic nightmare. But it is also a linguistic puzzle. In India, you have users constantly engaging in something called code switching.
What exactly is code switching in this context?
It means blending different languages, regional dialects, and heavy accents dynamically. So, a writer might start a sentence in Hindi, drop in an English technical term for a location, and then finish the sentence in a regional dialect, all while a rickshaw is honking in the background.
Yeah, that's intense.
Right. And traditional voice systems built by big tech companies completely break down under those conditions because they look for standard syntax in a single language.
So they get completely confused when the rules change mid-sentence.
Exactly. But Polaris is specifically architected to handle that colloquial, noisy speech. It processes the meaning and intent behind the audio simultaneously rather than translating it word by word.
Oh, I see.
Yeah, and because they don't force the user to change how they talk, meaning the writer doesn't have to speak in rigid, robotic English, they are winning these massive contracts. They're providing an intuitive experience that builds actual user trust.
It is an amazing technological moat. But, it makes you wonder about the broader landscape. I mean, you look at Apple integrating AI directly into the hardware of their devices.
Right.
And Google is basically trying to dominate every single search and voice interaction globally with their infinite money glitch. Like, these are companies with trillions of dollars essentially trying to own the entire AI space, from the phone in your pocket to the server in the cloud.
Right, but what does all that actually mean for SoundHound AI SOUN investors?
Yeah, that is the multi-billion-dollar question. How does a smaller company survive that kind of overwhelming gravity?
They survive and thrive through what we can call the neutral advantage.
Neutral advantage, okay.
Yeah. If you are a global automaker, say a European car brand or a major fast food enterprise, your absolute biggest fear is being locked into a single big tech ecosystem.
Because they basically become your competitor.
Precisely. You do not want Apple or Google owning your dashboard, gatekeeping your customer data, and dictating your future software roadmap. I mean, if Apple owns the dashboard, the automaker becomes just a piece of metal on wheels.
Right, commodity.
Exactly. So SoundHound AI, SOUN, provides a neutral, independent platform. They integrate the best models available, which is often their own Polaris model, to power things like voice commerce.
And voice commerce being the ability to actually buy things with your voice, not just, ask for the weather.
Right. It means a driver can order a coffee, book a restaurant reservation, or pay for a parking spot directly from their car dashboard. And crucially, SoundHound AI, SOUN, lets the automaker retain control of the branding and the ecosystem. Plus, they actually share the voice commerce revenue with the automaker.
So basically, it's kind of like they're the ultimate universal translator that doesn't force you into one specific tech ecosystem.
That is the perfect way to look at it. They are the independent partner empowering the brand, not the tech overlord trying to consume the brand's identity.
Okay, so compared to last quarter, what actually moved the needle here? Because, great technology and a cool neutral philosophy is only half the battle. How is this actually translating to the balance sheet?
Let's break down the fourth quarter of 2025 results. From a top-line perspective, the growth metrics are undeniable. Revenue hit $55.06 million for the quarter.
Wow.
Yeah, that is a 59.4% jump year over year. That strong finish pushed their full year 2025 revenue to nearly $169 million, which essentially doubled their revenue from the previous year.
Doubling revenue in a year is serious momentum. Are we seeing actual enterprise adoption driving that, or is it just like a few massive legacy contracts paying out?
No, it is broad adoption. They signed over 100 new customer deals in Q4 alone, spreading across global automakers, financial services, and massive retail chains. And a key metric driving those sales is their enterprise containment rate.
Containment rate, let's define that for the listener really quick. That's essentially the percentage of customer service interactions that the AI handles completely on its own, start to finish, without ever having to transfer the customer to a human agent, right?
Correct. And SoundHound AI, SOUN, recently announced that in certain enterprise deployments, their containment rates have crossed the 90% threshold.
90%. Wait, so if a restaurant chain gets 1,000 calls on a Friday night, the AI handles 900 of those orders perfectly.
Exactly.
That is a massive labor cost savings for the business. But, as an investor, I have to look at the profitability. I'm looking at their reported GAAP net income for the quarter, and it says $40.1 million.
Right.
I mean, for a young, hyper-growth AI company to print $40 million in positive net income seems almost too good to be true. There has to be a catch.
You are absolutely right to be skeptical, and we need to unpack how accounting works here. As an investor, you cannot just read the headline GAAP number and assume they are printing cash.
Okay, so what's the catch?
That $40.1 million net income was primarily driven by an $85 million paper gain on something called contingent liabilities.
Wait, a paper gain. So nobody actually handed them an $85 million check for selling software?
No, absolutely not. It is a non-cash accounting adjustment. When SoundHound AI, SOUN, made previous acquisitions, part of the deal structure often involves future payouts or warrants tied to their stock price.
Oh, I see.
Right, and because the stock price experienced extreme volatility, the estimated cost of those future liabilities dropped on their balance sheet. So in accounting terms, a drop in a liability is recorded as a gain.
Ah. Okay, so it is basically an optical illusion on the balance sheet. Like, if I owe you 10 shares of a company and the stock price suddenly tanks, technically my debt to you is cheaper. So my balance sheet looks better, but my actual business operations didn't generate a single dollar of that profit.
Exactly. It does not reflect their core operational performance at all. If we strip away that accounting noise and look at the hard truth, their non-GAAP net loss was $7.3 million.
Yikes.
Yeah, and perhaps more importantly, their free cash flow was negative $24.43 million for the quarter.
Got it. So despite the massive revenue growth, they are still actively bleeding cash to run the business.
They are definitely still burning cash. However, context is key here. They narrowed their adjusted EBITDA losses by 56% year over year.
Okay, that's good.
Yeah, that shows real operating leverage, meaning as revenue scales up, their costs aren't scaling up at the exact same pace. Plus, they are sitting on $248 million in cash in the bank, and they currently have zero debt.
Okay, so they have a solid runway to keep operating without the immediate threat of bankruptcy. But the race to actual operational profitability is very much ongoing.
Yes, very much so. And that $248 million war chest is crucial context for what happened next. Because SoundHound AI, SOUN, isn't just relying on organic growth.
Right.
They are heavily utilizing that cash and their stock to aggressively buy up their competitors, which brings us to their latest bombshell announcement.
Right. On April 21st, 2026, they announced they are acquiring LivePerson.
This is a massive strategic pivot. They are acquiring LivePerson in an all-stock deal that values LivePerson's equity at roughly $43 million. But when you factor in the debt they are absorbing to execute the deal, the total enterprise value of the transaction is $250 million.
Wow. That's a huge bite to chew. But they are acquiring a massive asset in return, right? LivePerson handles 1 billion customer messages a month across digital chat and text.
Exactly.
Plus, SoundHound AI, SOUN, gets to pull in $74 million of LivePerson's cash at closing, and the combined company is expected to emerge completely debt-free.
Yeah, it creates an omni-channel powerhouse. You have to view this in tandem with their previous acquisition of Amelia.
Oh, right, Amelia.
Yeah, Amelia brought them deep enterprise voice AI, and currently they are migrating 75% of their legacy Amelia customers over to their new Agentic AI platform version 7.3 by mid-year.
Okay, let's clarify Agentic AI for a second. That's a step beyond just answering a question. Agentic AI means the system can actually take actions, right? Like logging into a database, changing a flight reservation, and issuing a refund, all autonomously.
Exactly. It acts as an agent on behalf of the customer. Now, when you upgrade those Amelia customers to version 7.3, those containment rates we discussed earlier improve dramatically.
Okay, that makes sense.
And because SoundHound AI hunger containment directly equals massive upsell opportunities and much higher recurring revenue.
Right.
But we have to pause here because this brings up a massive operational risk. We have to address the critical bearish perspective, which the retail community on Reddit has been actively pointing out.
Right, Reddit is all over this.
Yeah. There is a well-known industry statistic that SaaS software as a service mergers and acquisitions fail to create value roughly 80% of the time. This is like a classic roll-up strategy.
Right, a roll-up strategy, where a company basically tries to buy up a bunch of smaller, often unprofitable software companies and stitch them together into one giant powerhouse. It sounds great on paper, but combining different software architectures, corporate cultures, and sales teams is notoriously difficult.
And the Reddit critique is completely valid here. SoundHound AI, SOUN's management team, has not historically executed M&A at this massive rapid-fire scale before.
Right.
So there is a very real fear of severe operational dysfunction, integration delays, and the fact that they are issuing huge amounts of stock to do this.
Hold on. How does that actually affect SoundHound AI, SOUN's stock price for regular investors like me?
It creates immediate dilution. Because the LivePerson acquisition is an all-stock deal, SoundHound AI, SOUN, has to print new shares to pay for it. When you increase the total number of shares in existence, your individual slice of the pie as a retail investor gets slightly smaller.
So the value of your shares is diluted in the short term.
Correct.
So you basically take short-term pain for the promise of long-term scale.
Precisely. The payoff model management is selling suggests that the newly combined company is targeting $350 to $400 million in revenue by 2027. But more importantly, they see a $500 million cross-sell opportunity pipeline.
Oh, meaning they can go to a LivePerson customer who currently only uses text chat and sell them SoundHound AI, SOUN's voice technology, and vice versa.
Yes. If they can successfully execute that cross-sell, the top-line growth could be explosive. But execution is everything. And right now, the market is aggressively pricing in that 80% M&A failure risk.
And that intense friction, between the promise of explosive top-line growth and the highly risky reality of an aggressive roll-up strategy, that is exactly why SoundHound AI, SOUN, has become one of the most heavily shorted stocks on the entire market.
Yeah, the mechanics setting up right now are truly a pressure cooker. Let's look at the actual short interest data.
It is wild. Almost 38% of the float is sold short. And let's define the float quickly. That is the number of shares actually available for the public to trade, excluding insider shares. So out of all the shares available, almost 40% or 146.6 million shares have been borrowed by short sellers, sold into the market, and eventually have to be bought back.
And the real story is the cost to maintain those short positions. In just 9 days in mid-April, the borrow rate exploded from 8% to 51%.
That's insane.
It is. Some institutional sources are even citing rates as high as 65%.
Okay, so why does a borrow rate spike like that? Let's break down the mechanics.
It is pure supply and demand. Think of it like trying to rent a car in a city where everyone is suddenly evacuating for a storm.
Right.
There are hardly any cars left on the lot. The rental agency can charge whatever they want because supply is virtually zero. In this case, almost all the available SoundHound AI, SOUN shares, willing to be lent out have already been borrowed. So the brokers who lend the shares just crank up the interest rate.
Which means the shorts are absolutely bleeding capital. I mean, at a 51% borrow rate, shorts are paying roughly $1,400 a day in fees for every $1 million they have shorted, just to hold the position open.
Exactly.
If you're bleeding that much cash daily, you must be incredibly confident that something catastrophic is about to happen. What is the fatal flaw the shorts think they found?
Well, institutional money is betting heavily on the May 7th Q1 earnings report. They are betting that the forward guidance will be weak, that the cash burn we discussed earlier will drastically accelerate due to the M&A costs, or that management will reveal the Amelia or LivePerson integrations are failing.
Wow.
Yeah. The shorts are playing a very dangerous game of chicken.
That's a standoff. We have to look at the days to cover metric, too. It is currently sitting at 4.85 to 7.5 days. What does that actually mean?
So days to cover calculates how long it would take for every single short seller to buy back their shares based on the stock's average daily trading volume. So if every short panicked and tried to buy at once, it would take roughly a full week of normal trading volume to clear them out. That means they are deeply trapped and exposed if the stock price suddenly surges.
So the May 7th earnings report is the match that lights this up. Both sides are just staring each other down, waiting for those numbers, because management has already set 2026 full-year revenue guidance at $225 to $260 million.
And here is the mechanism of the squeeze. If SoundHound AI, SOUN, delivers a strong beat on Q1 revenue, shows improved margins, and reiterates or raises that 2026 guidance, the shorts are trapped.
Yep.
The shorts, who are already bleeding $1,400 a day from those borrow fees, will be forced to panic buy shares to close their positions and stop the bleeding.
And when millions of shares are suddenly being bought by desperate short sellers, it drives the stock price up even faster.
Exactly. It creates a violent feedback loop. As the price spikes, brokers issue margin calls to other short sellers, forcing them to buy as well. The shorts are essentially trapped in a room where the walls are closing in. Every day they wait, those borrow fees crush them a little more, and if the stock price goes up on May 7th, the ceiling caves in too. That is a classic short squeeze.
But, to be perfectly balanced, if they miss expectations, then the bears win. It's just that simple. If they miss, or if the LivePerson acquisition shows signs of toxic debt and severe integration delays, the stock price will drop significantly.
And the shorts will gladly pay those daily borrow fees because the massive profit from the crashing asset will far outweigh the cost to borrow it.
Right. It is a true binary event.
It all comes down to May 7th. Every single metric, every piece of technology from Polaris to Agentic AI, and every dollar spent on these acquisitions gets put to the ultimate test. But as we wrap up today, I want to leave you with a deeper, long-term question to ponder on your own.
Let's assume SoundHound AI, SOUN, navigates this next week perfectly. Let's say they successfully squeeze the shorts. They integrate Amelia and LivePerson seamlessly over the next year, and they eventually hit their stated goal of a 30% long-term EBIT margin.
Okay, best case scenario.
Right, best case scenario. What happens to their standalone software moat 3 or 4 years from now, when Agentic AI inevitably becomes a native, built-in hardware feature on every single consumer device, like hard-coded into the chips of your phone, your car, and your appliances by giants like Apple and NVIDIA? What happens to the demand for a third-party software add-on, even a neutral one? That is the real horizon they are racing against.
Yeah, that's a very big question.
All right, listeners, what's your take on the future of SoundHound AI, SOUN? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.